My job is not necessarily to tell you how to do it. It's to give you options to help you build the plan that you think is best for you and your family. Hey everyone, Nick Nielsen, Certified Financial Planner. One of the things that I find so fascinating is asset allocation. What I've been seeing recently is clients coming to me and they're asking questions about what they own. And I think it's incredibly important to understand what you own, why you own it, and where it fits in to your picture. People are asking, I think now more so than ever, how much should I have in stocks? How much should I have in bonds? How much should I have in cash? And whose job is that? Is that my job as the client? Is that your job as the advisor? So I recently just did a whiteboard session where I talked about what an individual would need to retire at age 62, assuming they were age 50 today. I left the whiteboard up, and essentially if someone has $1 million today needing $8,000 a month from their portfolio, they need about $3.4 million at age 62. One of the fascinating takeaways for me is if someone had a 7.8% rate of return, they would need to contribute about $51,000 a year to fund the plan. If someone was expecting a lower rate of return, you would have to fund the plan at almost a rate of double, or $121,000 a year. So the asset allocation, how much you divvy up to stocks, bonds, and cash, and other things, real estate, cryptocurrency, basketball cards, wines, is really important in the rate of return that you can reasonably apply to them. So let's walk through a couple of ideas that I share with the clients that we're guiding on a daily basis. So I think most people intuitively understand that the stock market carries with it the potential for higher rates of return, and then it also has more volatility that comes with it. So the first thing before investing in stocks, it's super important to understand, the cost of admission. And so number one, historically, there is about a 15% drop every year. Doesn't mean necessarily that you lose 15% every year, but as the market makes its moves, maybe from this point to this point, the market went down 15% in a given year before it ultimately went higher over the course of 1 year. So that is volatility, how much market prices move. Secondly, in the US stock market in a broadly diversified portfolio, there is generally about a 30% drop or greater every 5 years. Now, once again, these things cannot be predicted or timed, but it gives us some idea, historically, of what we could potentially expect within our portfolio. And there have been, at least 3 times in the past 50 years where the S&P has essentially dropped in half. So it's just really important before we invest any of our capital into an asset class that we understand its historic volatility. Now, it could be less volatile or it could be more volatile in the future, but I think it's important to at least understand the past. And we think those two things are critically important to understand that long-term rate of return, which for our planning purposes, we use 7.8% for a low-cost, broadly diversified portfolio of equities. And the reason we come to that number is research has showed that that is the lowest 30-year historical, 30-year rolling return of the S&P 500, which we think is a good proxy for companies that have access to capital in the US stock market. You can't invest directly in the S&P 500. It's an index. You can buy index funds to try to mimic it. But we think for a planning purpose, you have to pick a number and you have to start somewhere, right? So if you can handle those first 2 bullet points of the cost of admission, the 15% drop, the 30% drop, we think that over the long haul, that the 7.8% rate of return is certainly possible from a planning standpoint. So the way that we build portfolios is we hope that over time, the market looks like this. Now, there is no guarantee. This is just for concept purposes only. Our personal belief is that we want to embrace volatility. The reason that we have the potential for the 7.8% rate of return or higher in the future is that we are taking on the volatility of these sometimes sharp downward movements. This is also critically important that for short-term assets, we do not want to be in stocks. That is where cash and short-term fixed income instruments are incredibly important. So when we're building out a portfolio, we want to make sure that we never put our clients in a situation where they have to sell into those extreme periods of weaknesses, kind of highlighted by my pink highlighted area. So when we go and build portfolios, we use this acronym of 6, 5, and 4. So first of all, we think that it's incredibly important to have 6 months worth of expenses in cash. And the rate of return on this cash is not overly important. The fact is, we think it's important that you have it for emergencies. Next is we want to make sure that we have 5 years worth of portfolio income in short-term fixed income assets. So for the example that we shared above, as we were trying to go from 1 million to 3.4 million, as we approach retirement, we would want that 5 years worth of portfolio income in something safe. So we were talking about having $137,000 per year. $137,000 times 5 gives us $685,000 that we would have in short-term, high-quality, fixed income investments. In the balance, we would invest, a little bit of play on words, for growth. So this is where we want to have access to ownership in companies. We want to take advantage of ownership in the underlying companies in the stock market in a broadly diversified portfolio. So that is how we go about building the portfolio. Notice that nothing that I said here has to do with age. Nothing that I said here has to do with risk tolerance or risk capacity. In the past 20 years, one of the problems that I have seen with risk tolerance questionnaires is that on the way, we'll put this in orange, is on the way up, people's risk tolerance seems to be more aggressive. They're more willing to take risks. They don't want to miss out, the FOMO. However, on the way down, on the pink line, people tend to be more conservative and they say that they don't want to lose anything. So we have found that risk tolerance questionnaires have been a very poor way to judge investment behavior and what they're really trying to do. We think that this approach has given the families that we guide a much better framework for how we build portfolios, and when people know what they own, why they own it, and where it fits into their overall financial picture, they're more apt to stick with the plan in good times and in bad. Now, this is not to say that someone could not own more than 5 years worth of portfolio income, but for most people, they are going to need a plan to own more equities to fund the plan in retirement. So take, for example, this gentleman here at age 50 who has $1 million trying to get to 3.4 at age 62. He did not have the ability to save $121,000 a year. He did have the ability to save $51,000 a year. So his situation dictated that he needed to own more equities. Or if he wanted to go a less volatile route, notice that I didn't say risk, I said volatility. Risk is much different. Risk is the ability to fund your family's most cherished dreams, goals, and aspirations. If someone needs to invest the money more conservatively, they just have to understand that 12 years is probably going to get stretched out to 15 to 20 years. My job is not necessarily to tell you how to do it, it's to give you options to help you build the plan that you think is best for you and your family. So at the end of the day, we believe in this concept, we kind of call it our upside down iceberg. We believe that your dreams determine your plan, and your plan determines your portfolio, right? Dreams determine the plan. The portfolio is nothing more than the funding mechanism of your plan. So if you don't know what you own, why you own it, or where it fits into your picture, just remember some of the things that we went through today, right? We start with kind of having the end in mind, needing to get to that 3.4 million. Before we own equities, we need to really understand what that cost of admission looks like, and then the 654. That's our starting point for our asset allocation, how much we have in cash, fixed income, and growth. I know this is a long video. I hope you found this helpful. I think the very best thing that we do is our Dollars and Diagram email. It comes out every Saturday morning. It would mean a great deal to me if you would sign up for that. You can do so in the show notes below. And if you like it, share it with a friend. It would mean a great deal to us. Thanks for checking out the video, and have a great day.